Good morning, everyone. My name is Teresa Crisanti, and I'm with the Illinois Restaurant Association, and I'd like to thank you for joining today's webinar, Worthy Tips for Tax Season. Today's webinar is being broadcast in English, Spanish, and Chinese. To listen in either language, please use the interpretation button in your toolbar. Before we begin, we'll hear from Dominique Gamble, Program Manager for the Cook County Small Business Source. Welcome, Dominique.
Good morning. Thank you, Teresa. Good morning, everyone. So again, my name is Dominique Gamble. I am Program Manager of the Cook County Small Business Source. We are in partnership with the Illinois Restaurant Association. The Cook County Small Business Source is currently working with a program that has been set up to assist small businesses throughout Cook County. We have been working this program for about 3 years now. It is a program that was actually developed out of COVID. We saw the need for small businesses to be able to survive was the initial impact developmental purpose for this program. And now we are now trying to assist businesses from going from surviving to thriving and going to the next level. So as you can see here, we have a few numbers. They have recently been updated. We have helped over 10,000 businesses throughout Cook County within the last 3 years. We recently just closed, some of you may have heard of the Cook County Small Business Source Grant, which we administer $50 million. So our grant distribution number is actually over 64 million. We're still in the process of closing out some of those numbers, so we haven't finalized that just yet. And then also we have helped over 9,000 businesses. So our impact is pretty high. We're really excited about the work that we're doing. Also, you can see here that a lot of businesses it looks like the businesses that we are actually pulling in are a high number of women in business. That number has also increased to 64%. And then also we have helped over 60% of people of color who are business owners. So we are really trying to make sure that we are tapping into all industries. It was really great to see them when we did the grant. It was a really diverse group throughout Cook County. We assisted businesses throughout all of Cook County who was able to receive the grant. And that was really great for us because that's our goal. And 76% of those businesses have maintained being micro businesses, which are businesses that are under 10 and fewer as far as employees. Can you do the next slide for me? The way in which we work is that we provide free services. A lot of people don't believe me when I say this, but our services are free. So we provide free business advising where you can sit down and work with one of our partners. We call them business service organizations. And again, the Illinois Restaurant Association is one of I call them mighty business service organizations throughout our partnership, where you can go to our website, you'll sign up for business advising, you'll be partnered with one of our partners, and they will work with you with whatever need or area of business that you will have need assistance with. So we work with all area and stages of business, whether it's the beginning stages, mid-level, or you want to take it, you've been in business for 15, 20, 30 plus years. We're still finding business owners, even in that stage, do still need assistance, even if it's in taxes or, trying to get your business. Some people we found also haven't even received their business license or kept it up to date. So we're really working with all stages of business in whatever area it is that they have need. We also provide free resources like this one. We're partnering with the IRA today to do what we're calling now is our free webinar Wednesdays, where every last Wednesday of every month, you will see the source is hosting a webinar in all areas, whether it's in marketing, we're doing taxes. We're also doing things for the hotel industry, which will be coming, I believe, in May. So stay tuned for that. You can connect with us on our newsletter and on our website. And we also have free in-person events. So anything that you would need is what we're offering. And you can connect with us through our website, which is also going to be connected here on the slide. You'll be able to see it in a minute, and we can also put that in the chat for you. But typically, if you're here, you're probably already working with us or you're working with the IRA. So we thank you for that. And we ask that you just continue to work with us so we can help you in whatever your next stage of business is. Can you go to the next slide for me? So here is our website, is cookcountysmallbiz.org. If you would like to sign up for free business advising, if you would like to sit down and work with one of our partners, I'm sure you're probably working with the IRA. They are great. They do great work, which is why I love working with them. And I thank them for this opportunity to partnership with us in our new webinar series, the Webinar Wednesday. And with that, I am going to throw it back over to you, Teresa. Thank you all. And I'm looking forward to the information that's coming next. Have a good one.
Thank you so much, Dominique. I'd also like everyone attending to know that the Illinois Restaurant Association remains a resource to you. We send regular email updates with what you need to know, and you can sign up for those on our website. So for today's webinar, you can use the Q&A button to post your questions at any time during the presentation, and we'll answer your questions at the end. Now, I'd like to introduce our panelists with us today, Deanna Chang and Chad McCoy from Plant Moran. Guys, please take it away.
Thanks, Teresa. I know Chad's going to present slides here in a second. So hi, everyone. Thanks for joining us today for some worthy tax tips. And so quick intro of ourselves. My name's Deanna Chang. I'm the current assistant treasurer of the IRA and a principal in Plant Moran's audit service. So I've worked with restaurant clients now for over 13 years. And joining me today is Chad McCoy, and I'll let him introduce myself as he'll be the one giving you the tax tips today.
Thanks, Deanna, and I appreciate you getting me involved. I've also been working, I'm a tax principal at Plant Moran. I've been working with restaurant and hospitality clients for 12 years now.
Great. So I just pop to the next slide. So I know there are many of you in this room that we work with already, and we wanted to give a quick overview of who we are and how we help those in the hospitality industry for those who aren't familiar with us. So here are some fast facts about Plant Moran for the numbers of people in the room. Now, as you can see, actually 2024 is our 100th anniversary, which we are very proud of. And while we do have offices worldwide, we have a strong concentration in the Midwest, as evidenced by the fact that we work with many of the IRA members. So where we excel is how we service our clients. So while we're among the nation's largest CPA firms, we are structured differently such that the various offices that we have aren't competing against one another. So instead, what we do is we employ this one firm strategy, which means that for every client that we service, we have the ability to bring the full resources of the firm. And it's not just siloed to say, oh, hey, the Chicagoland office can only work with Chicagoland people. And because we do specialize by industry, so Chad and I specializing in the restaurant and hospitality industry, we're able to bring a personalized level of service and expertise to our clients and customize our approach to their specific needs. So on this page, you'll see a quick summary of the capabilities of the firm. Our bread and butter are the traditional audit and tax services. However, you can see that we have a breadth of consulting and wealth management offerings as well. So we've helped our restaurant clients through things like implementing a new ERP system or valuation services if they're looking to raise money or sell part or all of the business, for instance. We also help regularly with estate planning and financial planning for restaurant owners and their families. So in addition to the hospitality restaurant industry, we also, here's a summary of some other service industries that we serve, if you're curious, or for those of you who may be involved in multiple projects, which I know like probably unlikely given how much time and energy that running a restaurant may take. So digging a little more into our industry expertise, within the food and bev industry, you'll see we have like a very deep bench of expertise and the range of clients we serve. So we have a very strong understanding of the industry and have expansive networks that we can pull upon to help support the growth and profitability of our clients. And this also includes franchises. So again, you can see that while we have a deep bench of expertise across many industries, we do have a very, very strong practice in the restaurant industry. So now that you've learned a little bit about us and Plant Moran, I'm gonna have Chad take over and go over today's agenda.
Thanks, Deanna. Appreciate the overview. So, we're for those of you joining by phone, if you can't see the screen, I'm just kind of looking through the agenda. We'd like to discuss the key tax deadlines and filing requirements, some important tax considerations, both for this year and maybe what's on the horizon. Especially in an election year. Tax credits and incentives updates, the Corporate Transparency Act, which maybe the first time that any of you are hearing these words, but definitely very, very important. Tips for preparing and filing taxes, and then we'll open it up to any questions that you have at the end. Hopefully Dan and I can help to answer either currently on the call or have a separate follow-up. So the key tax deadlines and filing requirements this year. So one of them's already passed on the 1099s on the January 31st, and we won't spend a ton of time. One thing to highlight is this year there are no, although it is a leap year and we get an extra day in February, there are no extra days for filing. In previous years, the deadline had fallen on a weekend, which required us to have a Monday or Tuesday filing, but partnerships and S corporations for a federal standpoint are due March 15th, C corporations on April 15th, as well as personal tax returns. Now, there is the ability, and some of you may already take advantage of this, to extending your returns. There are no extensions for 1099s that January 31st. However, you can extend your partnership as your business returns or your personal returns. One thing which is a constant reminder, the ability to extend filing is not an extension to pay. So to the extent you have any taxes due, you want to make sure that those are paid timely, either by the initial due date, and then you can have that extra time to get the filing in order and ready to go. So some important tax considerations there, and we'll flip to the next slide right away. But as we kind of begin this portion of the discussion today with the federal tax updates, we want to look back at some recent changes to tax law that have had an impact on our clients in particular in the most recent kind of the last few years. But some of the big items that we're going to be discussing, the beginning of bonus depreciation deduction phase out, the increasing restrictions on taxpayers' ability to deduct business interest expense, and lastly, what we're seeing in practice with the IRS from recent funding initiatives for greater resources and enforcement efforts. So, to provide a little bit of perspective, some of you have already noted that most of the items listed are not taxpayer favorable. So all of the things are reductions of previous initiatives that were extra cash in business owners' pockets and the restaurant pockets. And really that was the product of the Tax Cuts and Jobs Act, which started back in 2018. That was one of the most significant pieces of tax legislation in the last few decades in terms of breadth of changes to the Internal Revenue Code and tax compliance. Now, as many of you are aware, the legislation process requires analysis on the impact to the 10-year budget window, requires certain amounts of revenue raising to offset revenue reductions created by tax cuts. So to pass that, the act back in 2018, many of the provisions were on the screen were included as those revenue raisers. And the issue is that on the back end, the more favorable tax cuts went into effect immediately, but then the less favorable revenue raising provisions for the IRS are now coming due. So in order for them to get to balance the 10-year budget process. They gave the upfront benefit, but now we're starting to be on the back end where a lot of those things are starting to expire or be reduced over time. The biggest, as I stated, being bonus depreciation. So for 2023, instead of having the initial write-off of furniture, fixture, leasehold improvements, being able to deduct 100% of it, now it's being limited to 80% for 2023. And that's actually scheduled to reduce 20% per year all the way down until it reaches 0%. The tighter limitation on business interest expense deduction. So if you are taking out debt to help fund the business and the activities, depending upon the size of the business, you may not be able to take all of the interest expense as current deductions anymore. There are limitations that come into place that previously were not as applicable. Again, increases to IRS resources and enforcement. We have seen an uptick, particularly in partnership audits and being initiated. So the additional money that's gone to the IRS now, for a couple of years, there was not much to be had in terms of audits. They were not necessarily gone, but they were fewer and far between. And now we're starting to see a slight uptick in the audits, as well as the employee retention credit, which we'll touch on here in a little bit. So, looming expiration dates, most of the 2018 tax law changes expire after 2025. The SALT, the state and local tax cap for personal returns, which is $10,000 for married filing jointly, that's still in place, but set to expire after 2025. And then that 100% bonus depreciation. Another piece is the 20% qualified business income deduction. Now that is still in place for the next couple of years as it stands, but it is set to expire where you, for restaurants and the hospitality business, many of you have been able to take a 20% deduction on your income as it relates to the business itself. And again, a few years off, but that is set to expire here in a couple of years, the way that the law is currently written. So as stated, this is just kind of an overview of that 20% phase out approach of the deductions year over year. Now, I will say that, for all of the obviously everyone is located in Illinois today on the webinar. For Illinois, all of these bonus depreciation deductions are an add back. You're still subject to the tax in Illinois, and then it's taken over. If it's a furniture and fixtures for tax purposes, it's taken over a 5-year period. However, for federal as well, you can see by 2027, the way the law is currently written, we're expected it to go all the way down to 0%. So Congress continues to focus on revenue raising in the tax gap, whether it's real or perceived. Many are continuing to see news stories on IRS funding initiatives, including new hiring and modernization efforts. And if any of you have had the pleasure of calling the IRS in the last few years, it has been painstakingly long wait times. Now, I would say in the last couple of months, we've started to see, calls actually being answered, which is very helpful because we're getting notices in the mail, trying to call the IRS, sitting on hold for many hours at a time, not being able to get answers, and it can be very frustrating. Now, some of those things are starting to get a little bit better, but still a long ways to go. Now, employee retention credit, we've started to see inquiries, and the claims process can kind of be an example of this, that the IRS has effectively stated that they believe there's fraud in the employee retention credit, but they're currently putting it in the hands of taxpayers to come out and say that, hey, we weren't eligible. Here's the process for kind of paying those funds back. And we'll touch on that here in a little bit as well. And the only thing that is constant is change. Is a kind of a good quote for taxes from an enforcement. So presidential cycles can foster an environment for legislative change. There were significant changes after the 2016 and 2020 elections. That 2024 being an election year, it will likely be the same. We could see some additional things, maybe in the fact of those expiration dates coming in 2025. There's been a lot of bipartisan support for extending a lot of those tax favorable measures for business owners, and that would impact your guys' scenarios and situations completely. So again, we highlighted the Tax Cuts and Jobs Act on the things that we're going to change. So the biggest piece, and we'll go into this next, is that there may be some. This year is kind of status quo as it stands in the current environment and the current law for 2023, other than a couple of those expirations. So the tax law is written that it's going to continue. However, there has been, if you've been paying attention to the things that have gone through the House and the Senate in the last month and a half, there has been, and we're always good for acronyms in the accounting world, but the full name of the bill that's currently being discussed is the Tax Relief for American Families and Workers Act of 2024. It's a mouthful, but that is for short, it's the TRA-FWA. Well, if anyone can come up with a better acronym to force the accountants into, I'm all ears. Effectively, and we'll go into it, there was some bipartisan framework for a lot of these expiration and some of these issues that came up. And the first announcement was January 16th. Went to the House Ways and Means Committee. There was a bipartisan vote to advance the bill. The bill advanced without amendment in the House, and now it's stuck in the Senate. So if you asked me a month ago, I would have said that we're marching forward on some of the changes that are going to take place. Now it's a little bit more unclear. Some would say 50-50, it kind of depends on who you're asking in the industry. But the biggest piece of that we want to make sure that we pay attention to is restoration of that 100% bonus depreciation for all of you. So we said how it's going to drop down to 80% for those fixed assets and leasehold improvements. It's going to go back to the expectation, and the way the bill is currently written is that they would go back to 100% and they would make it retroactive to 2023. So if you haven't put it together yet, there is the initial deadline in 2 weeks, and then another one a few weeks after that. And there is some up in the air, on whether or not there's going to be this additional benefit of bonus depreciation. Our discussion with a lot of our clients right now has been, we're in a wait and see, and this is a good place to be in terms of we should see the movement in the next couple of weeks on whether or not this gets passed. If it gets passed, so delaying your tax return filing at least a couple of weeks, or having a discussion with your tax preparer to make sure what is the impact, what is the detriment if we choose not to wait to both the business owners and then to the business itself, or what does it look like if we file for an extension to be able to take advantage of this 100% bonus depreciation. The other piece that is in the TRA-FWA is the termination employee retention credit, which has been a substantial program for small business owners who have been able to qualify and take advantage of cash based off of their payroll, and be able to kind of really support the small businesses nationwide. The way it's currently written, there was a termination of new claims as of January 31st, 2024. Now that day could be moved. If you haven't gone through the ERC process, I would immediately start talking to someone because that date, while it may get moved to maybe when the bill potentially gets passed, there is currently a termination of new claims being filed. And also, and I'll say this many times, the IRS, it's one of their top audit areas of risk is the ERC promoters on ones that are going through with advertising and charging a percentage of the overall fee. Ultimately, it's just a understanding with the ERC, with whoever's done the computation, that they've fully vetted that you qualify and will receive the proceeds either you've received or will be receiving, just making sure that everyone's, ducks are in a row, that if for some reason there were to be a more widespread audit. So next we're going to move on to tax credits and incentives update. So the biggest being the FICA tip credit. Now, obviously, there's been a lot of discussion on tip credit both for Illinois and Chicago, and as well as nationwide over the years. Although we're going with the way that the current law is written and the ability. So it's the tip credit is calculated on reported tips. So if you're not reporting tips, you wouldn't be able to claim the credit. So it is on the employee side of their Social Security and Medicare tax to get a credit dollar for dollar on the reporting. The work opportunity tax credit. So we don't see this as often as we probably should being claimed. But please don't overlook this credit. And while it is not quite as lucrative, or it's not as big of dollars as the FICA tip credit, the work opportunity tax credit is for targeted groups, including qualified veterans, ex-felons, physically and mentally disabled, qualified summer youth. There's a lot of characteristics, and we do see in the hospitality industry, a number of these people being able to qualify. But I will say the qualification has to be done by filing with the Illinois Workforce Agency within 28 calendar days from the date the individual starts working for the organization. So while you can't do a look back and see, all of my employees that these X number qualified, but if you add into your onboarding process an additional questionnaire, most payroll companies will be able to talk you through how to at least get the correct information and filings related to this credit. It's a very easy add-on that there's no cost to the employee, there's no cost to the employer. It's just an additional questionnaire that you get credit. So the credit can be up to $1,500 to $2,500, $1,500 to $2,500 in the first year of hire, depending on the number of hours worked, and it could be a little bit more depending upon which target group. But again, it's just one of those that you either qualify or you don't qualify. So just kind of being aware. The employee retention credit. So we're not spending today going through what the qualifications are, but really just want to paint the picture of the history of where the employee retention credit program has been. So originally it was enacted by the Coronavirus Aid, Relief, and Economic Securities, or the CARES Act. Much better name than the current bill being processed. And then they were subsequently extended and modified by 3 separate pieces of legislation. So it continued to see value and continued to be extended. So the quarters of eligibility expired on June 30th, 2021. Amended payroll tax filings could be filed until the expiration of the statute of limitations. So we're coming up on that first statute of limitations for one of the filing requirements of the amended return right now. So in the fall of 2022, the IRS started to issue warnings about improper filings and that they were planning to escalate moving forward. And then there was an increased volume of filings noted along with marketing tactics of ERC promoters. And then in late 2023, which hopefully all of you have received your funds, but there was a complete pause on processing of newly filing claims that took effect on September 14th, 2023. There was a process to withdraw those pending claims on October 19th, and a voluntary disclosure process to repay was established at the end of December. So where are we now? The IRS is currently no longer processing new claims due to concerns over fraudulent claims. It does not apply to any previously filed claims that are still in process. Now, I will say that we've heard that the IRS has slowly begun to start processing those previously filed claims again, although I have a handful of clients that are still waiting on some refunds that they have not gotten any motion, but we do expect the processing of claims to start picking up soon. So they're also up in releasing the process of whether or not you were qualified. There was some new frequently asked questions that were updated and posted to the IRS ERC website. So the withdrawal process only applies to taxpayers with pending claims, but excludes those that have already received refunds and cashed the checks. So if you haven't received the cash, then that would be the process to understand whether or not there were any issues there. Therefore, I'll quickly go through the 4 criteria that must be met to utilize the withdrawal process. And if these criteria are not met, then the taxpayers still need to file an amended employment tax returns. So the claim must have been filed on an adjusted employment return, so 941X. The adjusted return was only filed to claim an employee retention credit. There were no other adjustments. Taxpayers now want to withdraw the entire amount of their claim. And the IRS has not paid or the ERC refund. So there's future guidance expected to become, again, not knowing everyone's individual scenario. The restaurant and hospitality industry, as you know, and we've experienced with our clients, has been substantially impacted. And it's really just a matter of making sure that your documentation is in a row. I think that by and large that the majority of restaurants did qualify for employee retention credit, but because they're in increased scrutiny, it's worth asking some of those questions. It's not of the vendor that helped with the ERC, just making sure you have the proper documentation in case something were to arise, because we do think there's going to be an increase in those. We've already seen an increase in the audits, and we do think there's going to be more to come. Other credits to be thinking about in Illinois are enterprise zones. So there are specific designated areas. There's on the illinois.gov website and listed the hyperlink on the slides. There's areas that if your restaurant or business is located in those zones, you get a 0.5% credit on property investment in the qualified zone. So all of your furniture and fixtures and leasehold improvements, all of that money, you can qualify for an additional credit. So in Chicago itself, they're in the Fulton Market area. There's a lot of those areas on the south side. There's a lot of those in enterprise zone program, but ultimately just that is also an area that we see frequently missed there. So it would be worthwhile to make sure if you think that you are, or at least knowing whether or not you fall within an Illinois enterprise zone. There's also the Clean Commercial Vehicle Credit program, and if you're not familiar, there was some additional guidance back in August of a $7,500 credit for vehicles under 1,400 pounds. This is both from an individual standpoint, so this was a very normal credit, but it's also on the business side. So if you have a clean commercial vehicle if you have a clean energy or electric or fuel cell motor on a fuel efficient car, it is worth looking into this credit and to see whether or not your business qualifies to take it. And again, there's some various links to give more details and background on the FICA tip credit, the work opportunity tax credit, this clean commercial vehicle credit, as well as there's a lot of information out there on the employee retention credit. The Illinois Restaurant Association has a number of good articles and links to look through and understand. We also have some to help walk through hopefully some of those questions. So one piece that we mentioned, and I'm hopeful that this isn't the first you've heard of it, but this is something that is going to impact every single person that owns a business through a pass-through, who has set up an LLC or an S corporation, is the Corporate Transparency Act beneficial ownership information reporting. So then this is a non-tax item, but we being, working with our clients and seeing the ownership and understanding if someone were to own multiple restaurants or locations or multiple businesses, because we do the annual tax filings, we just sometimes might have a greater understanding than even the attorneys, if there was a change that occurred and how these things kind of flow together, if multiple attorneys were used on setting up a business for you. By and large, the Corporate Transparency Act, it was enacted January 1, 2021, and effective starting January 1st of this year. So the rules require the legal entities to report details on their beneficial owners to the Treasury Department. It's actually being administered by FinCEN, which is the Financial Crimes Enforcement Network, and not the IRS. The penalties, so if you own, and we'll go through this a little bit later, if you own greater than 25%, there are some exclusions, but you may be required to file and register with FinCEN. And unfortunately, you haven't, if you've had a historic business prior to December 31st, 2023, you have 12 months to comply with this new requirement, and the penalties can be upwards of $10,000 or 2 years in prison for if you're willful failure to report or filing an incorrect report. Again, this is something to really take a look into. If you are starting a new business, a new restaurant, a new venture in 2024, you have 90 days from the day that you register with the Secretary of State for that LLC, that new business, to be compliant with this beneficial ownership information. After that 90 days, you could then be subject to these penalties. Please refer back to this slide as much as possible. Hopefully you're able to get a sense of the considerations it might look like. There are a lot of nuances. I would say by and large, it's likely that the majority of you will have some level of filing requirement. It's a very broad concept of what a legal entity is. It covers both domestic and foreign entities, regardless of tax treatment. There are exemptions. However, they're very specific exemptions. Effectively, if you have someone that owns over 25% of a business, or able to have substantial control, you will have a filing requirement to FinCEN. What is going to be reported is legal names, the street address, there's an identification number, and a copy of a driver's license or passport. Again, if you haven't heard anything on this, please reach out to your attorney, or other, we'll list some other resources, because I think it is something that we're not hearing enough people talking about, that it's going to have a huge impact. So tips for preparing and filing taxes. So in the tax world, and I can just speak to what is what's the easiest, and as you can imagine, organization and maintaining the records for your tax preparer. Retaining documents for at least 3 years, and a lot of that is because it's called a statute of limitation. You have 3 years, generally of 3 years, that there could be an audit on those tax returns, which would include receipts, invoices, bank statements, and tax returns themselves. This is maybe a little self-advocating, but also make sure you're choosing a qualified tax preparer, someone that has experience in the restaurant industry and familiarity with relevant tax laws. There are a lot of changes in the last few years, and more to come. There's a lot of things that specifically impact small businesses. There's a lot of things that specifically impact restaurants and hospitality. Utilizing your resources through the Illinois Restaurant Association with questions and comments, as well as making sure that your tax preparer is prepared to be able to that has knowledge of all this information, so that one, that you're filing compliantly, and then also that you're taking advantage of all of the things that you can in the tax law, and also getting way out ahead of changes on the horizon, like the reduction in bonus depreciation, like the holding for a couple of weeks to see if the Senate passes this bill that's retroactive to 2023, taking advantage of various credit opportunities, that's just additional cash in the owner's pockets. all things that are really important to take advantage of. And then lastly, the file and pay taxes on time. Like we said, you're able to file for an extension, but it's not a extension to pay. For example, a partnership which is due, a federal partnership which is due March 15th. The late filing fee is $220 per month per partner, and that can increase pretty substantially really quickly just by having the mistake of accidentally waiting a few extra days. Illinois, for the payments due, it could be if it's 1 day late, it could be 2%, an additional 2% penalty plus interest of the amount of the tax due. And if it's over 31 days, it could be it would be 10% of the amount due plus interest. Please make sure that you're paying these things timely, that you have documentation of when it's been paid timely. I would say that Illinois is very, they send out a lot of notices if something is 1 day late, even if it's a mail issue. So having that documentation that you submitted it timely, or even paying through the My Tax Illinois website is better, so that you know that it was submitted and received timely, is very important. So those are the main items that we wanted to highlight today. I see that there might be some questions in the Q&A. I believe that we wanted to
Yeah.
Yep, go ahead.
I was going to say thank you so much, Chad and Deanna. I know that's a lot of information for everyone to digest, so we'll be sending out the PDF and the recording at the conclusion of the webinar. So, and contact information for Plant Moran, so you can follow up with your questions. And yeah, Chad, as you were saying, we do have questions. I can just read them. Perfect. To you. So would you say ERC is going away for good?
That's a great nuanced question. I would say that everything. So number one, ERC was set up and it helped a lot of businesses, which was what his intention. The government did not anticipate the amount of people to claim and the amount of dollars that it was going to cost for the overall program. On both sides of the aisle, there's been a lot of agreement that it should go away for good, that there's been too much fraud in the program. And now they're trying to work through those issues now. So everything would indicate that ERC is going away for good. And given the fact that the most recent bill that hasn't passed yet has gotten bipartisan support, would suggest the same thing.
That's really helpful. Okay, and then regarding the audit risk mentioned for ERC promoters, what precautions should businesses take to ensure compliance?
Yep, that's a great question as well. So I would say that I would go back. You could go back to the promoters or go back to the documentation and just go through to make sure that that you qualified. The biggest issue with ERC was the wages couldn't overlap with PPP money, so the Paycheck Protection Program. A lot of the issues we see is where wage claims happened. There was no computation done to see the overlap between the two. And I would say that that's really what's gone on. So going back and understanding, did we qualify? Do I have the proper documentation from this promoter to be able to provide just for own documentation? So there's a 3-year audit risk on going back. So making sure that you have all your ducks in a row, just something for your file, because if you were to get something from the IRS 2 years from now, it's been a number of years since you've interacted. A lot of these promoters you interact with on a one-time project base, whether or not that person that you worked with directly is still there. Hopefully, the IRS, you guys have been working with good reputable companies. So, with Plant Moran, with other ERC. So, we would expect to be able to have all the compliance measures, but just going back and getting that documentation now, if you don't think that you have a good hold on it right now.
Great advice. Thank you so much for that. Well, it looks like we're at the end of our time. I don't know if you or Deanna had any closing comments or final thoughts. No. All right. Well, I'd like to thank you all for attending. Thanks, Dominique, for joining us this morning. Thanks so much, Chad and Deanna. And I wish you all a great day.
Thank you.
Thank you.
Thanks for having us. Thank you.
Bye-bye.
Bye.